Mr. Chairman, Temasek and GIC no doubt compare their performance against various global market indices and other standards of performance internally. It would be useful for these SWFs to publish these comparisons in their analysis for the reasons for better assessment of their performance. In fact, it would be useful for the government in the form of MOF to understand these comparisons in some detail. With that said, I would like to ask, how does the MOF itself assess that the SWF boards and management have done a reasonable job in terms of returns? What internal metrics, indices, benchmarks and processes are used? In the case of Temasek, the MSCI is used as a reference. As I understand it, Temasek also sets its own hurdle rate at a risk-adjusted cost of capital that its market value, TSR, has underperformed on the 1, 3, 10 and 20-year periods as of March 2020. It has argued its underperformance relative to the risk-adjusted cost of capital is because it is making a systemic shift to build resilience for the future. I would like to ask, does the government have clarity on the transformation Temasek is undertaking and why they think the future rate of return will outperform the current rate of return on these new investment strategies? Last cut on reserve spending. Mr. Chairman, the reserves consist of various classes of assets held by Temasek, GIC and the MAS. During typical economic crises, some asset values, such as equities, may fall on the whole. This is fairly typical. If a reserves drawdown is financed by liquidating assets in a time of crisis, this may not necessarily be advantageous for Singapore, since it may mean selling fundamentally good assets such as shares in good blue-chip companies, for example, at low prices, rather than hanging on to those assets to realize future value when the economy recovers. However, if the reserves drawdown is financed by borrowing against the collateral of the reserves, that may, in some circumstances, prove to be more advantageous to Singapore, especially given that interest rates may be lower in a time of global economic crisis as central banks slash the cost of credit to financial institutions, as they often do. Or is the first line of execution for a reserves drawdown utilizing cash or cash equivalents held by the MAS or other institutions? Hence, I would like to use this cut to ask the government what is the operating principle that determines how reserves drawdowns are financed and executed, with these considerations and questions in mind.
Mr. Perera asked about the performance of our investment entities. We've had this debate before. This question has been raised multiple times, and I've explained that both GIC and Temasek are long-term investors, and their remit is to secure good, sustainable returns on a total portfolio basis over the long term. So the relevant performance measure for them is not the year-to-year return, which can fluctuate because of market volatility, but sustained long-term returns over and above global inflation. And if you look at that measure, both GIC and Temasek have indeed performed creditably over the long term. Their results are published in their annual reports, and there's a full write-up explaining their decisions, the performance, and the evaluation of their performance. Take GIC as an example. GIC in recent years has recognized there's high uncertainty in the equity markets, as well as high valuations, which can lead to large permanent portfolio impairment. As a result, GIC has undertaken preemptive measures to reduce portfolio risk. Nevertheless, despite reducing its risk exposure, GIC's returns on its portfolio compared to a reference portfolio comprising 65% equities and 35% bonds, GIC's performance, despite a reduced risk, has been equal, if not better, than the reference portfolio. This has been so over the rolling 20-year period. It has also been so over more intermediate periods like a 10-year and 5-year time frame. So I think if you look at the overall performance on the broader term, longer term, not just year to year, I think both GIC and Temasek have done creditably well in a very challenging investment environment. Going forward, how do we ensure that such performance continues? There is never any guarantee in investments, but all the processes are in place by the boards to supervise management, between MOF and the boards to review the performances of these entities, and also with many discussions with external parties as well as investment advisory panels, very prominent names in the investment community sit on these advisory panels to help us guide our two entities.
In relation to assessing performance of Temasek and GIC, I think the Minister helpfully shared about advisory councils that help to guide Temasek and GIC. So my question is really that the government in the form of MOF is the sole shareholder, basically, of GIC and Temasek. And as the sole shareholder, is there a process within the MOF where you assess whether their performance is good enough? In past debates on this subject, I believe that the government has said its approach is a bit hands-off. It leaves it to the board and management. But I'm wondering whether there is a formal process every year or every few years to assess whether the board and management have done well or whether they've done not well enough so that they need to be taken to task, or in extremis, whether they need to be replaced. Does that sort of happen within MOF or somewhere else in the government?
The government continually reviews the performances of these two entities. There is a whole range of processes that we have put in place to do this. First of all, oversight by the boards, which they ought to do as part of their fiduciary duties. So the boards take these very seriously. Both entities have advisory panels, as I've highlighted, and that also provides guidance and oversight. MOF itself has a review process where we meet the board and management of Temasek on a regular basis. We get them to update us on their understanding of the overall scenarios, risk, the outlook and opportunities they can envisage over the horizon, and what kinds of investment strategies they have in mind. And then on top of all that, at the end of the day, it all comes down to the returns and based on the risk that they are taking, the returns that they are delivering. And as I've highlighted, we look at these returns not just on a yearly basis. I think that would be very short-sighted, and that would be detrimental and counterproductive. We look at it on an overall basis and over a longer term. So it's really a rolling returns over a longer period of time, preferably over 20 years, which we do, but then we have intermediate milestones and we look at 10 and 5-year periods as well. So that's the ultimate test, that they are able to deliver consistently good returns over the longer term.